Hello friends, welcome to Easyshots learning channel. Today's video is about redemption of preference shares. In this video, first we will understand how we deal with the questions related to redemption and how the company prepare balance sheet after the redemption process. Now here the balance sheet of A Limited is given. This is the closing balance sheet, and in this balance sheet under equity and liabilities column we have shareholders fund, and under shareholders fund we have share capital, in which 2 lakh equity shares of rupees 10 is given. This is fully called up and paid up capital, so we have equity share of 20 lakh rupees. Now when we are talking about redeemable preference shares, we have 50,000 8% redeemable preference shares of rupees 10 each, but only 8 rupees is called up and paid up amount. It means the final call is due. So in case of redemption of preference shares, if the shares are partly paid up and called up, we cannot redeem these shares according to section 55 of Companies Act 2013. So first we have to convert these preference shares into fully paid up preference shares, then we do the redemption process. So for this, first we have to call the final call on 50,000 shares at the rate of rupees 2, receive the final call, then after that we have to do the redemption process. So when we do the general entries of final call, here final call is due on 50,000 shares at the rate of rupees 2 per share. So the company due rupees 1 lakh and receive rupees 1 lakh from final call from their shareholders. So when the company due the final call, the installment account is debited and share capital account is credited, and our entry is preference share final call account debit to preference share capital account. Now here we due the final call with the amount of rupees 1 lakh. Now when the company receive the final call, the bank balance of the company is increased, and when the bank balance is increased, it debit the bank account. So our entry is bank account is debited to preference share final call account. Now the company received the final call of 1 lakh rupees. Now here the preference shares are converted from partly paid up to fully paid up, and preference share capital stood at 4 lakh plus 1 lakh, that is 5 lakh rupees. Now the company can easily redeem these preference shares because we have fully paid up preference share capital of 5 lakh. Now when we are talking about free reserves which are used for redemption of preference shares, here we have 3 reserves. One is capital reserve, which is not used in the redemption process. In case of out of profits, we can only use surplus account and general reserve. In surplus account we have 2 lakh rupees, and in general reserve we have 1 lakh rupees. Under current liabilities we have sundry creditors of 1 lakh. Now when we are talking about assets, we have non-current assets and current assets. Under current assets we have stock, debtors, and the company's bank balance stood at 5 lakh rupees. Under additional information, here on 1st April 2021, Board of Directors decided to redeem the preference shares at a premium of 10%. Now the company decided to pay the premium along with preference share capital to the preference shareholders. So when the premium is paid, premium is the extra amount which is paid to the preference shareholders. So our preference share capital stood at 5 lakh rupees, and 10% premium is given to them. So 10% of 5 lakh is 50,000. So the company pay 5 lakh 50,000 amount to preference shareholders and in case of redemption of preference shares. Now in additional information we also have, for redemption of preference shares, company issues sufficient number of equity shares of rupees 10 each. Now if any cash or fund is required by the company, then the company may issue equity shares for redemption of preference shares. Now we have to pass general entries and prepare balance sheet after redemption. Now first we have to understand how we do adjustment or redeem their preference shares by out of profits or out of fresh issue. Now we want 5 lakh rupees as nominal capital of preference shares. This 5 lakh is adjusted either out of profits or out of fresh issue, and the remaining premium on redemption of preference share is adjusted. First preference is given to out of profits, and if no amount is remain in out of profits, then we can use security premium reserve account for redemption of premium on redemption of preference shares. So first we have to adjust premium on redemption of preference shares, and we have surplus. In surplus account we have 2 lakh rupees, so we adjust 50,000 from this 2 lakh. Now we adjust premium on redemption, that is 50,000, from surplus account of 50,000. Now in surplus account we have out of 2 lakh we use 50,000 for premium on redemption of preference shares, so the balance amount is 1,50,000. Now first we adjust with out of profits, and then any amount remains in nominal capital of preference shares, then we use out of fresh issue. So here in surplus account we have 2 lakh rupees, we already adjusted 50,000, so the remaining balance in surplus account is 1,50,000, which is adjusted from nominal capital of preference share, that is 1,50,000, and the remaining balance we use from general reserve. In general reserve we have 1 lakh rupees, so from general reserve we take 1 lakh. So in out of profits we use 2,50,000, so the remaining amount in nominal capital of preference share is 2,50,000. So here the balancing amount is adjusted through out of fresh issue or by issuing equity shares. So here we issue equity shares, and the face value of equity share is rupees 10. So we issue 25,000 equity shares at the rate of rupees 10 each. Now we do general entries. The process of general entry is, first we transfer the whole amount of redemption of preference share to a new account, which is known as preference shareholders account. Then our entry is out of profits, out of fresh issue, premium adjustment, and last entry is redemption of preference shares. Now first we do the entry when the amount of preference share capital and premium amount which is paid to the preference shareholders is transferred to a new account, which is known as preference shareholders account. Now we debit the liability and the amount is transferred. So our entry is preference share capital account debit. Here the amount is 5 lakh rupees and premium amount is 50,000, and it is loss, that's why it is debited. So premium on redemption of preference share account debit, and the amount is 50,000, and the whole amount is transferred to a new account which is known as preference share holders account, that is 5,50,000. Now we transfer the amount to the preference shareholders. Now when we do the out of profits entry, here we take 1,50,000 from surplus account, and from general reserve account we take 1 lakh rupees. So when the amount is transferred from these reserves, they are debited because they have credit balance, and new account is created which is known as capital redemption reserve account for the purpose of redemption of preference shares. So when we transfer this amount, then we take 1,50,000 from surplus account. So our entry is surplus account debit. We take 1,50,000 from surplus account, and from general reserve we take 1 lakh rupees. So general reserve account debit with rupees 1 lakh, and the whole amount is transferred to a new reserve account which is known as capital redemption reserve for the purpose of redemption of preference shares out of profits. So to CRR, and the amount transfer is 2,50,000. Now we do out of profits entry. Now the balancing amount is adjusted through issue of equity shares at the rate of 10 each. Now we do the general entry of issue of equity shares, and when the equity shares are issued, the bank balance of the company is increased. So our entry is bank account debit to equity share capital account with the amount of 2,50,000, because we issue 25,000 equity shares at the rate of 10 each. Now we do the premium adjustment. Here we adjust the premium amount with surplus account, that is 50,000. Now when the surplus account is adjusted, then surplus has credit balance. When the amount is transferred, this account is debited, and this amount is used for premium on redemption of preference shares. So our entry is surplus account debit. We transfer 50,000 to a new account which is used, so to premium on redemption of preference shares. We use surplus account to redeem the preference shares at a premium of 50,000. Now we redeem the preference shares. This is our last entry. When the amount is transferred to this account is 5,50,000. So we pay 5,50,000 to preference shareholders, and our entry is preference shareholders account debit. Preference shareholders account is debited with 5,50,000 because it is our total liability to bank account. Here we redeem the preference shares and pay the whole amount to the preference shareholders. Now, how the company prepared the balance sheet after these journal entries? Now we discuss this. So first we deal with the liabilities and equity side. So here under share capital we have 2 lakh equity shares, and for redemption of preference shares we issue new equity shares of 20,000 25,000 equity shares at the rate of 10 each. So by adding 2 lakh is our 2 lakh shares. We already have 2 lakh shares, and we issue 25,000 new equity shares. So we have 2,25,000 equity shares at the rate of 10 each. So in equity share capital account we have 22,50,000. Now in liability side we have already redeemed the preference shares, so no entry for redemption of preference shares in balance sheet. Under reserves and surplus we do not use capital reserve. So under capital reserve we have 3 lakh rupees balance. So we write capital reserve 3 lakh rupees. Now in surplus account we have a balance of 2 lakh rupees which we used in out of profits and premium entry. So first we see the entry. In entry number 4 we use out of profits we use 1,50,000, and for premium on redemption of preference shares we use 50,000 from surplus account. So we write this. In surplus account we have a balance of 2 lakh rupees. In out of profits we use 1,50,000, and in premium on redemption of preference shares we use 50,000. So there is no balance remains in surplus account. Another reserve is general reserve. We have already used general reserve of 1 lakh rupees under out of profits. So there is no balance remains in general reserve also. So balance is nil. Now we created a new reserve in entry number 4 when we transferred the amount from these reserves to a new reserve that is known as capital redemption reserve account. So the new reserve is 2,50,000, that is capital redemption reserve account. So we write under reserves and surplus capital redemption reserve. This is our new reserve and the amount is 2,50,000. There is no adjustment in current liability, so we exactly write this amount, that is sundry creditors 1 lakh rupees. So we have sundry creditors of 1 lakh, and the total amount of liability side is 29 lakh. Now we deal with the asset side. In assets we have land and building of 10 lakh rupees and plant and machinery of 13 lakh rupees. No adjustment is given or no adjustment we do in the general entries regarding non-current assets. So we write these amount again in our balance sheet. So under land and building we have a balance of 10 lakh rupees, and Under plant and machinery, we have a balance of 13 lakh. So we write plant and machinery balance of 13 lakh. Now, when we talk about current assets, we have a balance in stock account 1 lakh rupees, sundry debtors 2 lakh rupees. So first we write these balances. Under stock, we have a balance of 1 lakh, and sundry debtors, we have a balance of 2 lakh. Now when the amount is received by the company, then the bank account is debited, and when the company pay to the preference shareholders or any other party, then bank account is credited. Now when we balance the bank account, here we have bank balance of 5 lakh rupees. So first we write this balance under cash at bank. We have a balance of 5 lakh rupees. Now when the bank account is debited, this bank balance is increased, and when the bank account is credited, this balance is decreased or reduced. So we see the general entries here. In our second entry, we have a bank balance because we receive final call amount of 1 lakh rupees, and in fifth entry, we receive the amount from equity shareholders by issuing equity shares, that is 2,50,000, and in our seventh entry we pay to the preference shareholders. So here the bank balance is reduced by 5,50,000. So we balance this amount and write the balance in cash at bank. So when we receive the final call, our bank balance is increased by 1 lakh rupees, and when we issue equity shares, our bank balance is increased by 2,50,000, and when we pay to the preference shareholders, we pay to preference shareholders the amount that is 5,50,000. So the balancing amount is, under balance sheet, we have a balance amount of 3 lakh rupees. So we write 3 lakh under cash at bank account, and the total amount of balance sheet is 29 lakh. So friends, in this video, first we understand how we do general entries related with redemption of preference shares, and how we prepare balance sheet after the redemption entries. If you like this video, please share this video and subscribe the channel. Thank you so much. Have a nice day.